Hi, welcome to my channel. Today we are going to discuss dividend theory. Basically, most of the investors of modern generation are active investors who are looking forward to maximize returns from their investments. If someone has invested in a stock, then it is natural for such an investor to look forward to getting back some kind of income each year. Incomes are provided by these firms in the way of payment of dividends. In previous discussion videos, we have already discussed what is a dividend, what is a dividend yield, what is dividend per share, what is earning per share, etc. So, what we would like to discuss in this session is that how dividend policies work for different firms, which kind of dividend policies management generally work on. So let's see what a dividend theory is meant to the management and also how it affects investors in general in the stock market and in general. So what is the concept of a dividend policy? As I have already told you in previous sessions, the term dividend refers to the part of the profit after taxes which is paid back by a firm to the shareholders. Part of the profit after taxes which is distributed among the current shareholders by a firm. The investors are generally looking forward to earn some kind of return which is revenue in nature. That means they will get cash returns each year apart from increase in stock prices, which is a capital return, capital gain. Both of them added together maximizes shareholders' wealth. But at the same time, one must also remember that a firm's management, a company management needs to investment certain portion of their profit after taxes into new projects, new investments, new firms, investing in expansion, investing in new plants, etc., bringing in new products, making research and development initiatives for future growth. So it is very common that some portion of current year's profits, profit after taxes, are reinvested to generate long-term growth and expansion. If a company pays out dividend, then that means no expansion will be possible if it pays all the profit as dividend. That is why they don't pay all the profits as dividends. So that is why earning per share is always, most of the times, greater than dividend per share. So that means only a portion, 60, 70, 50, 30% of the EPS is paid out as dividend per share. The balance is kept as retained earnings by the firm and it can be reinvested to increase future long-term growth. That is why the management needs to make a decision as to how much dividend it needs to pay, it must pay, it can pay, and how much it must retain to reinvestment for furthering future expansions. What issues one must consider before the dividend policies are decided? First, the owners. The needs of the shareholders are the most important and the management must understand that increasing shareholders' wealth, maximizing shareholders' wealth is in the best interest of the firm, and that is why dividend policy must be aimed at increasing shareholders' wealth, shareholders' return. Secondly, the need of the firm is easier to be determined by the management. So that means the board of directors and the share managers, top management of a firm, are in a position to know what the firm needs to reinvest to attract long-term growth. So, because it is well known fact that once a dividend is declared by a firm, it cannot be taken back, and then it becomes instantly a current liability debt of the company, and it must be paid immediately. The dividend decisions are a policy decision which must be taken in due consideration and after a thorough examination of the need of the firm. So board of directors must weigh the consequences before declaring a dividend, because they know a dividend once declared cannot be reconsidered, cannot be annulled. It becomes a current debt. It must be paid immediately. That is why dividend policy is an urgent matter for any firm's management. What is a dividend policy? So in that context, a dividend policy would dictate the amount of dividend that should be paid by the firm to the shareholders, and how many times dividends must be paid out by the firm to the shareholders in a financial year. For example, dividend can be paid quarterly, dividend can be paid twice a year, dividend can be paid at the end of year only once. If a dividend is paid at the end of the year, it is known as a final dividend. If dividend is paid in the interim before the financial year is ending, they are known as interim dividends. So when a firm makes a profit after tax, they must decide whether they want to pay a dividend to the shareholders, because the shareholders generally expect a dividend to be paid. So this means some portion of the profits must be retained by the firm, and some portion of the profit might be paid to the shareholders in the form of a dividend. So that has to be decided, how much dividend must be paid and what should be the frequency, how many times the dividend must be paid to the shareholders by the board of directors or the top management. So that's dividend policy considerations. So when you consider dividend policy, dividends can be paid regularly. That means every year the shareholders are paid a dividend. So under regular dividend policy, the company pays dividends every year without a break. If the company makes abnormal profits, that means if the suppose a rate of return is normally 10% for a company and it earns 15%, it can pay a higher dividend, and the balance is retained by the firm. However, if the company makes a profit, still the shareholders will be paid a dividend. The regular dividend policy is generally used by companies whose profits, earnings, revenues are very stable. For example, a company like Apple Inc., its revenue are quite stable, earnings are quite stable and growing. It has a very steady cash flow, which is obviously increasing. Its retained earnings are very large, so it can pay out dividends regularly without any break. Companies which pay dividends regularly are considered low risk investments because they pay back some portion of the profits without a break to the shareholders. And even if we consider that the amount of dividend is not very high, it still would mean the shareholders are earning a decent rate of return on their investment in that firm. So shareholders are happy because they get some kind of revenue returns on the amount they have invested in the stocks. So that's a low risk investment because they continue to get some kind of investments returns, unlike other firms which doesn't pay regular dividends. For example, a firm XYZ, if I go back a few years, there was a company called Yahoo, which was a major competitor for Google Inc. And Yahoo never paid dividends in its entire life period. So this means Yahoo Inc. was never certain of steady cash flows, and that's why they never paid uh, steady and regular dividends. The second theory that some firms usually follow is a stable dividend policy. Under a stable dividend policy, a particular percentage of the profit after taxes, can be paid out as dividend, and they generally maintain that percentage as a fixed percentage. For example, if the company sees that a payout of 40% is a fair return, then they will pay 40% of the earnings EPS as dividend per share. This means if earnings go higher, amount of dividend per share might increase, but the dividend payout remains at 40%. This policy means the dividend is stable and payout might fluctuate. They can maintain a stable payout, dividend per share might fluctuate, but such a policy is risky than a regular dividend policy, because shareholders are not certain what kind of earnings the firm would get in a particular year. As a result, even if the payout is fixed at 40%, their amount of dividend will fluctuate. For example, say XYZ Inc. gets an EPS of 10 $1 per share last year, and they pay 40%. That means 40-cent dividend per share is paid last year. Now, if the dividend per share, dividend payout remains 40% and the EPS increases from $1 to 1.50, then this year they will end up paying a higher DPS, that is $0.6, that is 60 cents. But what if the EPS declines to $0.8? The company will actually end up paying 0.32 as DPS. So that means even if the stable dividend policy aiming at a stable payout, the amount of actual dividend might be quite uncertain. And this is a risky policy for investors who are looking forward to generating a simple and good rate of return on their investments. The third policy is an irregular dividend policy. This is the most riskier of the three policies. The company management is under no obligation to pay dividends. There is neither a stable dividend payout nor a regular dividend payout. Even if the board of directors are earning quite a lot of profit, they retain most of the profit most of the year, and they might not pay any dividend at all. But they might pay, for example, they pay a dividend once in 3 years, once in 4 years. So this kind of investing companies which following irregular dividend policy actually quite risky, very high risky firms for the shareholders, for the investors in general, because they don't follow a policy which is beneficial for the retail investors in the market, because the retail investors are not sure if they're going to be paid any dividend at all. No dividend policy. This, like I said, Yahoo, they did not pay any dividend at all for many years, even if they made substantial profits. So it is because the profit earned is retained fully and reinvested fully. They give out dividends because they think that the company is growing rapidly and expanding and need quite higher amount of reinvestments. These are growing companies which needs big amount of reinvestments. So share price is going to be expected to be appreciating very fast. That's why they think they are under no obligation to pay dividends to the shareholders. So share price appreciation as per the investors are more valuable than a dividend payout. They say that means capital gain on stock prices increase is better than the dividend earnings that they can get. So quite stockholders who are uh, very well uh, known about the policies of such firms and who are very sure that such policies are very what do you call very good for the investors in the long term because they're going to get significant amount of share price appreciation in the future. But this policy is very high risky, as in the future the firm might not be able to generate a growing and considerable amount of cash inflows. There are some dates which are to be considered before dividends are paid. Declaration date is a date on which the board of directors declare dividend. So the date of declaration of dividend is quite important. Record date is a date which is considered to be a date on which the closing of stock transfer books. That means on that date, this is a cutoff date after which any stock transfers will not be considered for the payment of dividends. That means on this date, whoever is registered as stockholders of the firm will be paid dividends. Ex-dividend date means it is a date which is notified by the stock exchange as a date which will entail the buyer of share the dividend. This means if the uh, investor purchases a stock before this date, he will be entitled to uh, uh, get the dividend. So the buyer who buys the share before or on this date will get the dividend, but beyond this date they are not entitled to dividend. Payment date, the actual date of payment of the dividend in cash, transfer of cash to shareholders account as mentioned in the register of shareholders. Conclusion. The dividend and dividend policy of the company is very important for investors considering they have to take different amount of risk on their respective investments. Dividends can help investors earn a high return or low return. So a dividend policy is generally considered to be a reflection of the financial performance of a firm, and shareholders consider the financial performance before investing in stocks in modern business. So dividend policy uh, pursued by a firm is quite interesting. So we have come to the conclusion of this session. Dividend policy, types of dividend policy, dividend dates. So in the next session, we will consider a particular kind of dividend policy and how payment of dividend or non-payment of dividend reflect in the value of the stock or value of the firm in the next session. So kindly subscribe to the channel. We have come to the conclusion, and please, if you like the video, please like it, and you can write it to me through this mail, and you can also WhatsApp me. This is it for today. We will be starting a relevant dividend policy in the next session. Till then, bye bye. Thank you. Please don't forget to subscribe to the channel. Thank you very much.